All right, everyone, welcome. Today we are diving deep, and I mean deep, into an IPO that has a ton of people talking. It's the Hong Kong listing for the super fast-growing restaurant chain, Xiao Noodles. And let's just cut right to the chase, shall we? This company is hitting the market with a 78 times price-to-earnings ratio. So, is that completely insane? Is it just classic IPO hype? Or are we maybe looking at a massive growth opportunity that could actually justify that price? That's the big question we're here to answer today. So here's how we're going to break it all down. First, we'll cover the basic facts of the deal itself. Then we'll get into the fun stuff, the business model, how they actually make their money. After that, we'll run the numbers, look at the risks, the red flags they're waving themselves, and then get into the nitty-gritty of the deal structure. And finally, I'll give you my final verdict and tell you exactly what I'm doing. Okay, first things first. Let's just look at the essential details of the IPO. So the stock code is 2408.HK. That HK is important. It tells us these are H shares, meaning it's a mainland Chinese company listing in Hong Kong. The price they're aiming for is somewhere between about 5.6 and 7 Hong Kong dollars a share. Now, you have to buy in lots of 500 shares, so your minimum ticket to get in is right around $3,500. All of this puts the total company value somewhere between 4 to 5 billion Hong Kong dollars, with CMB International leading the deal. All right, so those are the specs of the deal, but what is the actual company behind these numbers? Let's figure that out and really decode their business model. This is the engine that's supposed to power that huge valuation. The whole secret sauce here really comes down to a three-part system they've built to just replicate and grow fast. First up is standardization. You've got to make sure that a bowl of noodles in Beijing tastes exactly like one in Shanghai. That builds brand trust. Second, digitalization. They're using AI for things like analyzing customer complaints and even predicting how busy a store will be to get staffing rate. And third, and this is the big one, their growth driver, franchise expansion. It's an asset-light model that lets them scale up like crazy without needing tons of their own cash. Now, this is where it gets really clever, how they handle their franchisees. It's a bit of a balancing act, right? On one hand, they treat franchisees like customers. They hand over the brand, the playbook, and to really encourage people to sign up, there are no crazy sales targets or minimum orders. But on the other hand, Xiao Noodles keeps a super tight grip on the one thing that matters most, pricing. This is how they protect the brand and their own margins. It's a pretty smart way to grow fast while staying in control. Okay, so the model seems pretty solid, right? It seems scalable. But does that actually translate to the bottom line? Let's switch gears and check out the financial scorecard. Time to see if the numbers really back up the story. And wow, the growth is, well, it's undeniable. I mean, just look at this chart. Revenue basically tripled in just 2 years. We're talking from around 400 million RMB in 2022 to over 1.1 billion in 2024. That's a massive, massive post-pandemic rebound, and it shows their expansion plan is absolutely firing on all cylinders. And here's the crucial part. This isn't just growth for the sake of growth. The profits are actually there. They finally hit profitability after the pandemic, and get this, in the first half of this year, their adjusted net profit literally doubled compared to last year. This tells us the model isn't just scalable, it's actually financially sustainable. But, and this is a huge but, here it is, the slide that kind of puts a question mark over everything. Xiao Noodles is asking for a 78 times PE ratio. To put that in perspective, a well-established giant like Haidilao is trading around 20 times. So they're asking us, the investors, to pay almost 4 times the premium for their growth story. This, right here, is the central dilemma of this entire IPO. You see a valuation that high, and you absolutely have to start asking, okay, what could go wrong? So let's do that. We're going to go straight to the source, to the risk factors section of their own prospectus, and see what the company itself is worried about. And the first thing they tell you, flat out, is to be ready for a bumpy ride. They're saying the stock price could swing all over the place because of market mood swings and things that are completely out of their hands. Look, this isn't just standard legal stuff. It is a direct warning that this high price tag could make for a pretty wild ride after it lists. And when you dig a little deeper, you find some specific operational issues. For example, almost 5% of their leased restaurants have some kind of documentation problem with the land they're on. They also rely on a whole web of licenses just to stay in business. They're dealing with tricky data security laws, and they admit that in the past they weren't fully compliant with paying for employees' social insurance. They say they fixed it, but it's still a bit of a red flag about how things were run before. And here's another one, a direct warning from the company. They are telling you, ignore the news articles, ignore the hype, and please read the official document. Why would they say that? Because the prospectus is the only thing that's legally binding. It's a huge reminder to base your decision on the facts, not the headlines. Okay, so we've covered the business, the financials, and the risks. Now let's get into the mechanics of the IPO itself. How the deal is structured can actually tell us a ton about supply and demand on day one. So this deal uses something called clawback mechanism B. Now that sounds super technical, but just think of it like this. In a normal IPO, if tons of regular people like us want to buy, a certain percentage of shares has to be moved from the big institutions to us. Mechanism B gets rid of that mandatory rule. It gives the company more control over who gets the shares. That could mean fewer shares available for the public, even if demand is through the roof, which, in turn, can help keep the price from going crazy on day one. And this is a huge vote of confidence. Almost a quarter of the entire IPO is already sold to what are called cornerstone investors. These are the big, smart money players who agree to buy in and hold for a while. And look at this list. We're talking the legendary Hill House Capital, and even their competitor, Heidelau, is buying in. I mean, when your rival invests in your IPO, that's a pretty powerful signal that they think you're onto something. Okay, we've gone through the business, the numbers, the risks, the deal structure. Let's put it all together now for a final verdict and, most importantly, a strategy. So after weighing everything, the good and the bad, I'm giving this IPO a 4-star rating out of 5. It's a positive view, for sure. I'm acknowledging that, yes, the valuation is a major risk, but the growth story and the way the deal is set up are just too compelling to ignore. And here's the paradox that gets me to that rating. Yes, the PE ratio is high, no doubt about it, but the deal itself is actually pretty small. The whole company is valued under $1 billion US. Smaller IPOs just have different physics. A smaller supply of shares can sometimes lead to bigger price pops if demand is strong. There's just more room for the price to potentially run. So that leads me to my final actionable strategy. I will be actively participating in this one. In fact, I'm going to subscribe to this IPO, Xiao Noodles, and another small cap IPO, Able Digital, and I'm going to split my capital right down the middle, 50-50 between the two of them, to balance things out a bit. And, the process we just walked through, that's really the big takeaway here. This is a framework you can use for any IPO. You have to learn to cut through the noise, to balance the exciting story with the cold, hard numbers, to actually read the fine print on the risks, and then build a strategy that makes sense for you. So I'll leave you with this final question to think about. When a company like this comes out priced for absolute perfection, what are you really betting on? Is it the solid fundamentals of the business itself? Or is it a bet on the market's incredible hunger for a good growth story, even if it comes at a really steep price? That's the question you really have to answer for yourself.